Hello viewers, welcome again to Already Late, your preferred channel to learn about economy, investing and finance in the most simplified manner. Now welcome to the first video, the first lecture, the first lesson in this equity masterclass. Is it possible to make money in stocks? Now, this is one question that has always been on the minds of individual investors. And when I ask this to people, most answers that come are based on experiences and strong opinions. Now, before I try to answer this question with facts, let us understand why is this question always asked about equities as an investment only. Every other financial investment, whether it's a fixed deposit, a PPF, NSC, a corporate bond, a government bond, now all these investments come with a guaranteed rate of return. Traditionally, an average Indian, people like you and me, we have grown up surrounded by these investments. And because of this, we have developed a mindset, this mindset which looks for fixed returns. On the other side, equities do not offer any guaranteed returns. There's no guarantee. So what happens is a new investor coming in is very uncomfortable. And that is why this question comes in, that is it really possible to make money in stock market? And it's a very, very trending question. So let us get back to the question. Is it possible to make money in stocks? To answer this, you will have to understand how equity markets behave. Now look at this chart. This chart shows you the journey of BSE Sensex, the oldest index available to track Indian stock markets. Now we have data available for over 40 years. The movement of Sensex can be roughly considered as an indicator of the overall performance of the stock market. The first thing that you observe is that the trajectory of this movement has been steadily rising. Now this is in line with the belief that stock market tends to reward those who have the patience to wait for a long term. Now, while the chart largely shows an upward trajectory, you can also observe now that the journey has not been very smooth. If we take a closer look at a couple of time periods, let me just zoom in for you, you can see that there has been a lot of hurdles in this journey. The journey has not been smooth sailing. Now, these hurdles mean lower or negative returns for the investors during that particular time period. So now the question is, how long should you invest for if you are investing in shares? How long is long term? Now once again, this question comes in because there is absolutely no lock-in period for your investment in share market. Now you can buy shares and sell them without any restrictions on time frame. Sometimes even in a minute or so, I've seen people buying and selling shares. Now this makes it difficult for an investor to decide on an ideal time frame for investing. So instead of giving you a straight answer to this question, I will again share some data with you so that you yourself can get the answer for this question. I just did some quick number crunching and asked myself, would I make money if I invested in stock market, let's say in Sensex on a daily basis or on a monthly basis or on a quarterly basis? I took various time frames and back tested this question with some data, and let me share the data with you. So if I look at daily investments, let us say I invest every day and I sell the I hold my investment for a 1 day period. I buy today and I sell next day. Again, I buy the next day and I sell the next day. So I'm holding it for 1 day maximum. So since its inception in 1979, so there are 9,605 days of data which is available for Sensex since its inception till the time I made this video. So if I were to buy Sensex for a 1 day period, which as I said means buy on any day and sell on the very next day, I would have had positive returns on 5,067 days and negative returns on 4,537 days, nearly 50-50 chance. Similarly, if I had bought Sensex for a period of 30 days, a monthly basis, what would happen? I would make money on 60% of those times. From 50-55, it's come to 60 now. So if I increase my time frame from 30 days to 90 days, or 180 and 360, so I'm just elongating my investment time period. I'm just increasing the time. So my positive return percentage, which was 50 for a single day, 60 for a monthly period, is now, as you see, it's going up. What's happening? It's going to 64% for 90 days, 70% for 180 days, and a good 75% for a period of 1 year, 360 days. Now, if I extend the time period for 2 years, 3 years, you see from 75 I'm moving to 88, I'm moving to 90. And if I continue 5 years, 7 years, 10 years, which is typically what we talk about long term, you see my positive return percentage over the history of Sensex has gone to 94, 99 and 100%. So in the history of BSE Sensex, if you had invested on any day, the worst day, the best day, does not matter. If you had invested for 10 years, you would never lose money. That is what the data shows. Now, you might say this data was for Sensex. Sensex only comprises of the top 30 companies, and what about the overall market? Now, this trend, I did the similar testing for BSE 200, an index which tracks 200 companies, roughly where most of us investing in direct equities try to stick around to these 200 companies most of the times. So you see the trend is very, very similar. We start with a 50-50 chance for a 1 day period, and then go on up to 100% chance once again if I go up to 10 years of investing. So nothing major different from BSE Sensex and BSE 200. So what does it mean? Now, very, very simple. This data is telling you loud and clear that the longer the time frame of investing, higher is the probability of you making positive returns from the stock market. So is it possible? Yes, it is possible. Now, please remember that I am not telling you that you will definitely make money if you remain invested for 10 years or more, just because the past has been. What I am only trying to tell you is the longer you remain invested, the higher your probability becomes. Well, data on positive returns is good, but when you're taking risk and investing in stocks, I am sure you expect returns which are much better than what you can earn without taking any risk, like your fixed income investments. So in the current market scenario, you can earn around 6% on your non-risky investments. So would it not be interesting to see how have markets performed compared to this particular return, let's say a 6 or a 7% return? Now, using the same data of BSE Sensex and BSE 200, I put in a couple of filters. First, I just put in a filter to see on how many occasions have these two indices managed to give returns more than 7% if your investment horizon was 1 year or above. What I found is that if you invest in Sensex for 1 year duration, 68% of the time your returns are greater than 7%. Now, this number of 68% increases to almost 75% if it's a 2-year investment horizon, 81% for 3 years, almost 90% for 5 years, 94% for 7 years, and a hoping 100% if you're investing for a 10-year period. Same thing for BSE 200. You make returns more than 7% on 61% occasions if you invest for a 1-year time period. Now, this increases to 65% if your investment horizon is 2 years, almost 77% if it's 3 years investments, 87% for 5 years, almost 92% if you're investing for 7 years, and 100% once again for a 10-year investment duration. Looking at 7% returns, I got a little greedy, and then I put in a filter to see on how many occasions have these two indices managed to give returns more than 9% for an investment horizon of 1 year and more. What I found, curious to know, yes. I found that Sensex for 1 year duration gives you returns more than 9% on 66% of the occasions. This number is once again, it's increasing. It's going to 70% if it's a 2-year investment, 78% if it's a 3-year investment, 87% for 5 years, and almost 91% for 7 years, and just under 99% for a 10-year investing period. So if you're invested for 10 years in the past, 99% of the chances are that your returns would have been more than 9% if you are invested in the BSE Sensex. For BSE 200, you make returns more than 9% on 58% occasions if you invest for a 1-year time period. Now, this is again increasing, 61% for 2 years horizon, 71% for 3 years, 84% almost for 5 years, 88 for 7 years, and 98% of the times your returns are more than 9% if your investment horizon is 10-year period. So what does this data tell you? Now, this data gives you a pretty good idea about what you can expect from your equity investments if you invest in a planned and a disciplined way with a really long investment horizon. Another factor of equity investing is that the returns are very volatile. Imagine you invest a lakh of rupees in stocks and a year later your investments are worth only 50,000 rupees. How would you feel? Bad, sad, angry, depressed, frustrated, or anything else? So it's very important, before trying to learn how to identify good stocks, you need to be prepared for scenarios like this. Now, you think this is unreal? No, this is. Let me share some more data, final set of data for this video about the fluctuations in the returns from stock markets. Now, the table on your screen that you see gives you the returns that Sensex has delivered for various time frames of investing. Now, barring the 1 day and the 1 month returns, the returns look pretty decent, right? The average returns are wonderful. But there is a big fundamental flaw in looking at averages. They never reveal the true story behind these averages. Now, in this same table, if I add just two more columns, the lowest returns and the highest returns, yeah, what was the highest for that period? What was the lowest for that period? Look at this. Now, the story suddenly becomes extremely adventurous. Now, look at that, 1 year investment. The average was 20.09%, but the range of return is as high as 124% and as low as a minus 51%. This means on a good day, you could have more than doubled your investment in 1 year's time. And if you had invested on a bad day, it would have been half in just under a month. Once again, this is not just limited to Sensex. It can happen to any stock, any index at all. Now take a look at BSE 200. The pattern is extremely similar to the Sensex. A lot of wild swings on both sides, very neatly masked behind the average return. So when you look at averages, it's pretty lucrative. But what we need to know is there is a lot of ups and downs, and we need to be prepared for that. This volatility is an inherent characteristic of investing in stocks. You need to be mentally prepared to ride these swings on both sides. Now, does this mean equities is for those who are ready to take risk? Of course, yes. You do not understand this risk and you invest. Very soon you will get frustrated and upset that you have lost a lot of money. Let me ask you the question which I started this video with. Is it possible to make money in stocks? And I am sure by now you have a fair idea about the answer. You can definitely make money in stocks. All you need is patience, discipline, control over your emotions, and the knack of identifying the right stocks to invest. In the next video, we will see the two predominant ways of making money through equity investing. Stay connected, keep learning, and do not forget to subscribe and hit the bell icon to get notifications about future lessons. Thank you.